Hey investors, welcome to my channel, where we turn complex financial reports into actionable insights. In this video, I will walk you through companies' key business metrics, analyze their growth trajectory, and break down their financial performance in simple, clear terms. So let's get started. Alphabet Inc. is a technology company that focuses on organizing information. The company operates globally, with a presence in Asia, Europe, and North America. Alphabet employs 183,000 employees. In the past 3 months, there has been a 9.83% increase in the stock value. Alphabet operates through 6 key segments. These are Google Search and Other, YouTube Ads, Google Network, Google Subscriptions, Platforms and Devices, Google Cloud, and Other Bets. First, Google Search and Other focuses on delivering information access. It does this through its search engine, email service Gmail, Google Maps, and the Google Play App Store, helping users find what they're looking for online. Next, YouTube Ads provides advertising solutions on YouTube. This allows businesses to connect with specific audiences using video and other ad formats. Google Network provides advertising solutions for businesses. It displays ads on partner websites and apps using platforms like AdMob, AdSense, and Google Ad Manager. Google Subscriptions, Platforms and Devices offers subscription services, app sales, and hardware products. These provide consumers with entertainment, productivity, and connectivity tools, like YouTube Premium, Google One, and Pixel devices. Google Cloud supplies cloud computing services to enterprises. This includes infrastructure, platform, and application solutions for businesses globally through Google Cloud Platform and Google Workspace, and its AI solutions. Finally, Other Bets focuses on innovative ventures in healthcare and internet services. It aims to solve complex problems in diverse industries, with projects like healthcare-related services and autonomous driving technology. Now, let's look at the shareholder returns of this company. This year, the company recorded a return of 35.45%, falling short of the industry average of 39.7%, but performing better than the market's 27.35%. This indicates a strong footing in broader market trends, though there's an opportunity to close the gap with industry leaders. Let's look at the company's impressive revenue performance. Revenue grew by 9.29%. Looking at the quarterly trend from Q4 2023 to Q4 2024, revenue increased from $86 billion to $96 billion, showing a consistent upward trend. The company demonstrates robust cash generation. Free cash flow increased by 40.82%. Looking at the trend from Q4 2023 to Q4 2024, we see a significant increase from $8 billion to $25 billion, indicating strong cash flow generation capabilities. The company shows strong cost management capabilities. Gross margin stands at 57.90%. Since Q4 2023, this number has fluctuated but remained relatively stable, starting at 56.47% and ending at 57.90%. Operational efficiency shows notable improvement. Operating margin is at 32.10%. The trend from Q4 2023 to Q4 2024 shows an overall increase, starting from 27.46% to 32.10%. Although there were minor fluctuations between quarters, profitability shows positive momentum. Net margin is 27.51%. Over the past 5 quarters, we've seen net margin fluctuate, starting from 23.97% in Q4 2023, peaking at 29.80% in Q3 2024, and settling at 27.51% in Q4 2024. The company maintains healthy liquidity levels. Current ratio stands at 1.8. Looking at the quarterly trend from Q4 2023 to Q4 2024, we've seen a decrease from 2.1 to 1.8. The current ratio tells us how easily a company can pay its short-term bills. Think of it as having $2 in your checking account for every dollar you need to pay this month. Generally, a ratio above 2 is considered strong, showing the company has ample resources to meet its short-term obligations. The company maintains a conservative debt profile. Debt-to-equity ratio is 0.3. From Q4 2023 to Q4 2024, this ratio has fluctuated, starting at 0.3 dipping to 0.2 mid-year before rising to 0.3 again. This ratio is like comparing your mortgage to your home equity. A lower ratio means less financial risk. Generally, a ratio below 0.5 is considered comfortable, though this varies by industry. The company demonstrates robust debt servicing capability. Interest coverage ratio is 609.4 times. The quarterly trend from Q4 2023 to Q4 2024 shows a significant increase from 354.8 to 609.4, indicating a strengthening ability to cover interest expenses. Think of this as how many times over the company can pay its interest bills, like having $9 available for every dollar of interest payment. A ratio above 5 typically indicates strong financial health. The company shows outstanding return on shareholder investment. Return on equity stands at 32.1%. This measures how efficiently the company uses shareholder money. Think of it as the return on investment for company owners. Generally, a return above 15% is considered attractive to investors. The company shows reasonable cash reserves. Cash to total assets ratio is 5.2%. From Q4 2023 to Q4 2024, we've seen initial stability around 6%, a mid-year dip to 4.6%, before recovering to 5.2%. This ratio tells us how much of the company's resources are in readily available cash, like having emergency savings in your bank account. Generally, a ratio above 15% indicates strong liquidity. Now, let us analyze how this company is performing when compared to its peer. The company's price-to-earnings ratio is 23, while their competitors are averaging around 37. In simple terms, you're paying 23 rupees for every 1 rupee of company's earnings, compared to 37 rupees you'd need to pay for the same earnings at their competitors. This lower valuation suggests you might be getting better value for your investment compared to its peers in the market right now, though it's worth investigating why the market has assigned this lower valuation. The company's price-to-sales ratio is 6.59, while their competitors are averaging around 7.05. What does this mean? You're paying 6.59 rupees for every 1 rupee of company's sales revenue, compared to 7.05 rupees for competitors. This lower valuation could indicate better value for investors, as you're paying less for each rupee of the company's sales compared to its peers. The company's enterprise value to EBITDA ratio is 16, compared to the industry average of 48. In simpler terms, this lower ratio suggests the company might be undervalued relative to its peers when we look at its overall business value compared to its operating performance. It could represent an attractive opportunity, though investors should understand why the market values it lower than its competitors. Now, let's break down what analysts are expecting over the next 2 years. According to analysts, the company is expected to show earnings per share of 8 rupees in 2025, growing to 10 rupees in 2026, representing a 14% growth. For context, in Indian markets, a growth company typically shows earnings growth above 15 to 20% annually, while mature companies usually grow between 8 to 12% per year. Looking at revenue estimates, analysts project 14% growth. Generally, growth companies in India should show revenue growth of at least 15 to 20% annually, while mature companies typically grow revenue at 7 to 12% per year. The company's key strategic initiatives involve several core areas. The first initiative is to expand AI overviews in search, with a focus on making it multimodal and broadening use cases, especially with younger users. Moving to the next point, Google is focusing on driving growth in its cloud offerings with AI, specifically Vertex AI and AI Hypercomputer, to win and deepen customer relationships and drive revenue growth, targeting both infrastructure and application layers. Another key area is monetizing YouTube through multiple avenues, including expanding shopping affiliate programs and integrating ads across various formats, such as shorts and living room experiences. Additionally, the company is actively developing AI agents, like deep research, and incorporating them into products such as the Gemini app, to expand use cases beyond information retrieval to task completion and deeper research. Finally, Google is investing in research and development of quantum computing chips like Willow, indicating commitment to long-term technological breakthroughs, despite the uncertain timeline for practical applications. capital allocation priorities include several key areas for investment. The company expects to invest approximately $75 billion in capital expenditures in 2025, primarily in servers and data centers, to support AI and cloud growth, with $16 to $18 billion planned for the first quarter. In addition to infrastructure investment, the company will continue to return capital to shareholders through share repurchases, having returned $15 billion in the fourth quarter, and dividend payments, with $2.4 billion returned in the fourth quarter. Another priority is to continue to build new cloud regions and data center campuses, including subsea cable projects, to expand cloud presence and global connectivity. Furthermore, the company intends to grow headcount in key investment areas, specifically AI and cloud, suggesting a focus on hiring and retaining specialized talent. Finally, the company is continuing to optimize their real estate footprint, indicating a focus on cost-efficient real estate management. The company's execution track record demonstrates achievements across various sectors. The company achieved a $110 billion annual revenue run rate for cloud and YouTube. Waymo has significantly increased its operational scale, safely serving more than 4 million passenger trips. Gemini model usage amongst developers doubled in 6 months, reaching 4.4 million, showcasing effective developer engagement and adoption. Moreover, GCP grew faster than the overall Google Cloud, indicating efficiency in GCP infrastructure. Lastly, YouTube achieved the #1 position for podcast listening in the US, demonstrating the successful integration of podcasts into the YouTube platform. The stated metrics show that these initiatives are showing growth. Forward guidance provided by the company includes several expectations. The company anticipates a negative impact on first quarter revenues due to the strengthening of the US dollar against key currencies. Additionally, there is a revenue headwind due to one less day in the first quarter of 2025 compared to the leap year in the first quarter of 2024. The company also expects that the lapping of strong revenue growth in the financial services vertical in 2024 will negatively impact search revenue growth in 2025. Furthermore, the company indicates that variability can be expected in Google Cloud revenue growth rates in 2025 based on when new capacity comes online. Finally, depreciation expense growth will accelerate in 2025 due to the increased capital expenditure investments in recent years. The company is preparing for these expected headwinds and benefits. So, what do you think about this company's future prospects? Would you consider investing in this company? I'd love to hear your thoughts in the comments below. If you found this breakdown helpful, please take a moment to like this and subscribe to the channel. It's completely free, and your support motivates me to create more in-depth analyses every day. Thanks for watching, and I'll see you in the next video where we'll dive deep into another exciting company.